So welcome back. We're going to continue our lesson on chapter 6, which was journal entries and how to start recording journal entries without the use of T accounts. So we talked briefly about the importance of general journal and how you start recording the actual journal entries in the journal. So just to go back to what we were discussing last time, if you can take a look at these couple of slides, you will notice some of the example journal entries. Just to reiterate again, if a client pays $500 cash for services, you're looking at debit cash, credit revenue. If a client is billed $1,000 for services, you're looking at debit accounts receivable. AR stands for accounts receivable, as you know, and credit revenue 1,000. So you see how the amounts are indented, and the accounts also represent the first there is the debit account, and then the credit accounts follow. So the next slide also gives you certain examples of journal entries. Here you can see that the owner has put in $25,000 cash and debit cash $25,000, credit capital $25,000. The owner has withdrawn $10,000 cash, debit drawings account $10,000, credit cash account $10,000. So these were some of the journal entries which you should refer to as you do your exercises, your assignments, and as you study for your tests and quizzes. So the next thing we're going to talk about in this chapter is the importance of source document. Source document is the actual document that you take a look at to record the journal entry. It gives you evidence, it gives you proof as to this transaction actually occurred. It is an objective way of proving that this transaction occurred. You don't just verbally say that I bought $10 worth of this. You have to have a receipt, a document. These documents are called source documents, meaning that they are original documents to the business. So one example of it is the cash sales slip. You can see that the cash sales slip indicates the amount of cash that was collected by the business, and if there was tax collected, we stated on it as well, and the customer paid you cash. The next example is a sales invoice. A sales invoice means that you have provided a service or some kind of a product to the customer, and the customer may take a few days to pay you. So at this point you record it as an account receivable, and when the customer actually pays you, you then record it into your bank account. So just to elaborate on this account receivable concept once again, this is when the customer or client promises that they will pay you later. However, you have to record revenue, because revenue is recorded when it is earned, not when cash is received. Remember the revenue recognition principle. So you would record debit, account receivable, credit, revenue, and then when the customer actually pays you, you would decrease the account receivable, which means you credit the account receivable and you debit cash because they have now paid you. So the next one is a purchase invoice. A purchase invoice is when you are the customer. You have now purchased something and you are going to record it in a debit or a credit kind of a situation. Another source document is a check. A copy of a check is like proof that you have made this payment. So if you have made this payment, that means that now you have to decrease your accounts payable. And that means that you have made this payment to the vendor. Vendor is something or someone that is the opposite of a customer. There can be certain bank advices coming to you, meaning that if for some reason you have taken a loan, let's say from a bank, or you have some savings in the bank account and they are giving you some interest, or it can also be just an advice saying that they are going to charge you for some kind of bank fees or bank charges. These are known as bank advice. Usually they are on the bank statement. However, they can also be given to you separately. So when this comes to you, this needs to be recorded. If you owe interest in your business from a loan or something, then of course you have to record it as debit, interest expense, credit, bank, because they will take the interest right from there from your account. Same thing if you were to earn interest, you would debit bank and credit interest revenue. So this is what a bank advice may look like. It's not always the case that it looks like this, but this is one of the methods of bank advices. So now the next concept, which is the last concept in this chapter, is about sales taxes. So of course everyone is used to paying or collecting in some ways sales taxes. Sales tax is a great source of revenue for the government. The government takes a percentage of any item, any service that is sold. But how do they collect it? They have to collect it from the business, because the business is the one that is selling these products or services. They cannot directly collect it from the customer. So they have given a registration to each business. Each business then becomes responsible in collecting the HST on any product or service that they provide. So I'm sure whenever you go to a restaurant, to a store, to a retail outlet, to an office, wherever, you would notice that they are collecting HST on top of what you are going to pay from the product or service. That HST does not belong to the business. That HST belongs to the government. So when you make that payment, they have to record it in their accounting books as separately. They do not just record it as sales. So you can see that they actually have to record it properly. I'll show you some of the example journal entries in a couple of minutes. However, there is a bit more to this. So a business collects all the HST from all their customers. But of course, they also pay out HST, because when they're buying products or for their rent or for their all of these expenses that they have to pay HST on, they have to pay HST to other businesses. So HST that they collect minus the HST that they pay is what they owe the government. I hope that makes sense, because that is the only amount that they pay as far as HST is concerned. So HST they collect minus the HST they pay is what they owe. So you can see that I have written down a couple of formulas here on this PowerPoint. You can see that HST collected minus HST paid is what is the difference is HST owed to the government. However, it can be the other way around too, meaning that HST collected may be less than what the HST that they have paid out. So maybe when the business is suffering a loss or they're starting out, they've got lots of expenses, so they may pay more HST in the beginning of their business life. So HST collected minus HST paid, if that is a negative number, then of course the government will refund the HST to the business. Next slide, you can see that HST payable is a liability account and HST recoverable is a contra liability account, which means that HST payable is something that they will have to pay to the government. HST recoverable is, of course, is something that's refunded to them, to the business, and that's why that's considered a contra liability account, because it is still a liability as far as HST is concerned. However, if it's on the other side, which means if it's a debit rather than a credit, it's a contra of that liability. Okay? So you can have contra liabilities and contra asset accounts, which we will talk about later in the course. So you can see some of the example journal entries right here. This clinic has now bought furniture for $10,000 cash plus HST. So you can see that the debit account is furniture, $10,000. But however, you have actually paid out $11,300 in cash. So credit cash, $11,300. Where does the remaining $1,300 go, which is the HST? It goes in HST recoverable. And then you can see a client pays $20,000 plus HST. So the client has paid $22,600, with the $2,600 being HST. So debit cash $22,600. However, the business has really only earned $20,000. So credit revenue $20,000 and HST would be $2,600, which is the difference. So that's how HST is recorded, and you can choose to use HST payable for both type of journal entries. You don't need to have HST payable and HST recoverable. In the end, they are both together anyways, because you're looking at the difference. Remember, HST paid minus HST collected minus HST paid. So that's how you come to the conclusion anyways. So we've covered a few things here. This chapter is quite important in the sense that it introduces you to journal entries, introduces you to source documents, how important they are.